Everyone wants to make money in crypto, but most people have no idea how the market actually works. They chase hype, buy at the top, and panic sell at the bottom, falling victim to the same cycle over and over again. But what if I told you that Bitcoin and altcoins follow a predictable pattern, driven by global liquidity and macroeconomic trends? What if you could spot the next bull run before it even starts? Welcome to the Chainpoint channel. In this video, we're going deep into the real mechanics of the crypto market, from the 4-year cycle and Bitcoin halvings to the hidden influence of institutions, debt cycles, and global liquidity. You'll learn why bear markets last so long, what triggers parabolic bull runs, and how FOMO and liquidations create extreme volatility. Let's dive in. But before we continue our talk, don't forget to hit the subscribe button to stay tuned to what is happening in the crypto world. And remember, everything we say here is not investment advice. Always invest wisely. Let's get started. The crypto market isn't just random price swings. It follows a well-defined 4-year cycle, largely dictated by Bitcoin halvings and global liquidity trends. Each cycle consists of bull and bear phases, with Bitcoin acting as the primary driver of market sentiment. This cyclical nature creates patterns that traders and investors attempt to capitalize on, though external economic factors like inflation and interest rates can modify its course. Understanding these cycles helps investors navigate the space without being swept away by market euphoria or panic. The bear market phase typically lasts 2 to 3 years, during which Bitcoin and altcoins see drastic price reductions. This downturn is fueled by investor fatigue, reduced liquidity, and mass liquidations as leveraged traders get wiped out. Many inexperienced investors leave the space believing the market is dead, only for the cycle to repeat itself later. Historical patterns show that those who accumulate during these downturns benefit the most when the next bull market arrives. The bull market phase, on the other hand, spans 1-2 years and is triggered when Bitcoin breaks past its previous all-time high. This event signals renewed confidence, attracting institutional investors and retail traders looking to profit. Bitcoin's rally ignites a chain reaction, with capital flowing into altcoins as traders chase higher returns. The final stages of the bull market are often marked by speculative mania, leading to unsustainable price surges before an inevitable crash. These cycles are not purely speculative. They align with global liquidity trends. When central banks inject liquidity into the economy, risk assets like Bitcoin benefit. Conversely, when liquidity contracts, crypto is one of the first markets to crash. This interplay between macroeconomic forces and crypto fundamentals is key to understanding why Bitcoin moves the way it does. But what actually happens during the bear market phase, and why does it last so long? The bear market is where weak hands get shaken out and only the most resilient investors remain. This phase, typically lasting 2 to 3 years, is marked by falling prices, lower trading volumes, and overall pessimism in the market. Bitcoin and altcoins experience massive declines, often losing 70% or more of their peak value. Many projects collapse due to lack of funding, and interest in crypto fades as mainstream media declares it dead once again. But seasoned investors know this phase is simply part of the crypto cycle. One of the key drivers of a bear market is excessive leverage and mass liquidations. During the bull run, traders borrow heavily to maximize gains, but when prices start falling, their positions get liquidated, leading to cascading sell-offs. This triggers a self-reinforcing downward spiral where declining prices force more liquidations, accelerating the crash. CoinGlass liquidation data often shows billions of dollars wiped out in a matter of days, further fueling panic. Investor sentiment shifts drastically during a bear market. Fear dominates, and many people sell at a loss just to escape the pain of further declines. The Crypto Fear and Greed Index often hovers in extreme fear territory for months, reflecting widespread pessimism. Institutional investors, however, use this phase to accumulate Bitcoin and other solid projects at discounted prices, preparing for the next bull cycle. This is why understanding global liquidity trends is crucial for spotting the market bottom. Bear markets don't last forever, though. Historically, Bitcoin finds a macro bottom when global liquidity starts expanding again. This shift signals the beginning of the next accumulation phase, setting the stage for a future bull run. But what exactly triggers a bull market, and how can investors recognize the early signs of recovery? A bull market doesn't start overnight. It builds up gradually as Bitcoin breaks key resistance levels and investor confidence returns. The turning point usually happens when BTC surpasses its previous all-time high, signaling the end of the bear market and attracting a flood of new capital. At this stage, institutions and retail traders alike start rotating liquidity back into crypto, setting off a domino effect of rising prices. Early adopters who accumulated during the bear market begin seeing massive returns, fueling optimism across the space. One of the strongest catalysts for a bull market is Bitcoin halving, which occurs every 4 years. Each halving event cuts the BTC mining reward by 50%, reducing the supply of new coins entering the market. Historically, this supply shock has led to Bitcoin's price surging within 18 months after the halving. The last 2 bull runs followed this pattern, and analysts predict a similar outcome for the 2024 and 2028 halvings. With less BTC available and demand remaining steady or increasing, prices naturally rise. Investor psychology plays a massive role in pushing the market higher. As BTC climbs, fear turns into greed and more traders FOMO into the market, driving prices up even further. At this stage, media coverage explodes, influencers start making bold price predictions, and mainstream adoption grows. The increased attention also brings institutional interest, with hedge funds, corporations, and even governments looking to gain exposure to Bitcoin as a legitimate asset class. The final confirmation of a bull market is when capital starts flowing aggressively into altcoins. Bitcoin's dominance declines as traders rotate profits into smaller, high-risk assets, creating parabolic rallies in altcoin markets. But this phase is also where speculation peaks, leading to unsustainable price increases. What happens next? The Bitcoin halving might be a catalyst, but understanding how it impacts supply and demand is key to predicting market moves. Bitcoin's halving event is one of the most important mechanisms driving its price cycles. Roughly every 4 years, the mining reward is cut in half, meaning fewer new BTC enter circulation. This creates a supply shock, reducing the number of coins available while demand stays the same, or increases. The logic behind this price surge is simple: basic supply and demand economics. If the number of new coins being created drops by 50%, and buyers still want Bitcoin, the only way to match demand is through higher prices. Miners who receive these block rewards are forced to sell fewer BTC to cover operational costs, further limiting supply. This effect compounds over time, creating an environment where even small increases in demand can lead to explosive price movements. But the impact of the halving isn't immediate. It takes months to play out. The real fireworks typically begin when Bitcoin surpasses its previous cycle's all-time high, attracting mainstream attention and new retail investors. At this point, the market transitions into full-blown bull mode, with speculative mania taking over. While halvings reduce Bitcoin's issuance, they also highlight BTC's scarcity, a major reason why it's often compared to digital gold. With only 21 million BTC ever to exist, each halving brings us closer to full supply issuance, making existing coins more valuable. But Bitcoin isn't the only asset that benefits from this supply squeeze. Altcoins also see explosive growth as investors chase the next big thing. Let's dive into why altcoins boom during bull markets and how unit bias plays a key role. During every bull market, Bitcoin leads the way, but altcoins eventually steal the spotlight. This happens because investors look for higher returns and rotate their profits from BTC into smaller, riskier assets. As a result, many altcoins experience parabolic price increases, with some gaining 10x, 50x, or even 100x within a short period. The final months of a bull market are when altcoins see their biggest pumps, as speculation reaches its peak. A major factor driving this phenomenon is unit bias, the psychological tendency to prefer cheaper-looking assets. Many retail investors believe that buying 10,000 units of a $0 1-cent altcoin is better than owning 0.001 BTC, even if Bitcoin has stronger fundamentals. This misconception leads to a surge in demand for low-priced altcoins, fueling massive speculation. Meme coins and microcap tokens benefit the most from this, creating short-lived bubbles before an inevitable crash. Liquidity plays a crucial role in the altcoin boom. As BTC's price stabilizes near all-time highs, traders and institutions start diversifying into altcoins, injecting billions of dollars into the market. This capital rotation is self-reinforcing. As altcoins pump, more traders pile in, driving prices even higher. However, most of these coins have weak fundamentals, and once liquidity dries up, they crash much harder than Bitcoin. While some altcoins bring real innovation, the majority exist purely for speculation. Understanding how to time the altcoin cycle is crucial for maximizing gains and avoiding major losses. But there's one factor that influences both BTC and altcoins equally: market psychology. Crypto markets aren't just driven by fundamentals, they run on fear and greed. These emotions dictate buying and selling behavior, leading to extreme price swings. When prices are rising, investors feel unstoppable, piling into trades with high leverage, convinced that the trend will continue forever. But when the market turns, panic sets in, and many dump their holdings at massive losses. This cycle of euphoria and despair repeats itself every 4 years. A key driver of market volatility is leverage trading. Many crypto exchanges offer up to 100x leverage, allowing traders to bet big with borrowed money. This amplifies both gains and losses, making the market even more unstable. When a large number of traders get liquidated, it creates cascading sell-offs, causing massive price drops within minutes. Websites like CoinGlass track these liquidations in real time, showing billions of dollars wiped out in a single day. The Crypto Fear and Greed Index is a perfect reflection of market sentiment. In bear markets, it stays in extreme fear territory for months, with most investors too afraid to buy. In bull markets, it shifts to extreme greed, where everyone is desperate to get in, even at inflated prices. Ironically, the best buying opportunities appear when fear is highest, and the worst times to buy are when greed is at its peak. But few traders can resist the psychological traps of the market. Understanding these emotional cycles is crucial for surviving in crypto. Those who control their emotions and stick to a strategy tend to outperform those who chase hype and react impulsively. But there's one psychological trigger that wrecks more portfolios than anything else: FOMO. Let's break down how it drives massive rallies and brutal crashes. FOMO, fear of missing out, is the most dangerous emotion in crypto. As prices skyrocket, new investors rush in, convinced they'll miss their chance to get rich. Social media explodes with hype, influencers make wild predictions, and everyone seems to be making money. Except you. This creates a panic buying frenzy where people throw money into anything that's pumping, often without understanding the asset they're buying. The problem? FOMO-driven rallies are unsustainable. As demand skyrockets, prices go parabolic, often doubling or tripling in days, but behind the scenes, early investors and whales are already taking profits, selling their holdings to latecomers. This is how retail investors end up buying the top, right before the inevitable crash. It's a classic cycle: hype, euphoria, blow off top, collapse. Crypto crashes happen fast and brutally. When momentum shifts, panic takes over, triggering mass liquidations and chain reactions of selling. BTC and altcoins can drop 30 to 50% in hours, wiping out leveraged traders and shaking confidence across the market. Just like in the 2021 bull run when Bitcoin hit $69,000, FOMO took over, only for the market to collapse to $15,000 within a year. Avoiding FOMO requires discipline. The best investors buy when no one is interested and take profits when everyone is euphoric. The key is recognizing the signs of an overheated market: parabolic price action, extreme greed, and unsustainable hype. But what really fuels these boom and bust cycles? The answer lies in global liquidity trends and how they dictate money flow into crypto. Crypto isn't an isolated market, it moves in sync with global liquidity cycles. When central banks flood the economy with cheap money, investors take on more risk, pushing Bitcoin and altcoins higher. But when liquidity tightens, the opposite happens. Crypto is the first market to crash as speculative capital dries up. This is why Bitcoin's major bull runs have always aligned with periods of loose monetary policy. A perfect example is the COVID-19 liquidity boom. In 2020 and 2021, governments printed trillions of dollars to stimulate the economy, causing 30–40% inflation in the global money supply. This excess liquidity flowed into risk assets, stocks, tech companies, And of course, Bitcoin. The result? BTC surged from $3,800 to $69,000 in less than 2 years. But as soon as central banks started tightening policy in 2022, crypto markets collapsed. Liquidity moves in predictable cycles, roughly every 4 or 5 years. Institutions and governments refinance their debts during these cycles, causing liquidity contractions that directly impact crypto prices. Research suggests that it takes up to 2 months for newly created liquidity to flow into Bitcoin, meaning tracking global liquidity trends can help predict market movements. This connection between crypto and macroeconomics is crucial. Investors who ignore liquidity cycles often get caught off guard by sudden market reversals. Understanding when money is flowing into or out of the system can help traders time their entries and exits. But beyond liquidity, large institutions and Bitcoin whales also play a huge role in market movements. The crypto market isn't just retail traders gambling on altcoins. Institutions and Bitcoin whales control much of the liquidity. These large players use their capital strategically, accumulating BTC during bear markets and unloading it at the peak of bull runs. Unlike retail investors, they have long-term strategies, using tools like on-chain analysis and macroeconomic trends to guide their decisions. One of the biggest advantages institutions have is access to cheap capital. Many hedge funds and large investors borrow against their Bitcoin holdings, using BTC as collateral for leverage. This lets them buy more assets without selling their BTC, amplifying their returns during bull markets. However, this strategy also increases risk. When prices drop, liquidations cascade through the market, fueling extreme volatility. Macroeconomic factors also dictate institutional behavior. When interest rates are low and liquidity is abundant, funds rotate into risk assets, including crypto. But when central banks tighten monetary policy, like in 2022 when the Federal Reserve raised rates, institutions pull money out of crypto, leading to steep market declines. Bitcoin's correlation with the stock market, particularly tech stocks, has grown stronger due to institutional involvement. Understanding how these large players move capital is key to navigating the crypto market. Retail investors often react emotionally, but institutions operate on data, liquidity cycles, and long-term positioning. But there's one deeper force that ties everything together: debt, cycles, and central bank policies, which dictate global liquidity and crypto's long-term trajectory. Crypto markets don't move in a vacuum. They're heavily influenced by global debt cycles and central bank policies. Every 4 or 5 years, governments and large institutions go through debt refinancing periods where they either roll over their existing debt or take on new loans. These cycles determine liquidity availability, and since Bitcoin thrives in high liquidity environments, tracking these macroeconomic trends is crucial for predicting crypto's trajectory. One of the biggest macroeconomic risks to Bitcoin is liquidity contraction. If central banks continue to raise rates aggressively, investors move away from speculative assets and shift into cash, bonds, and stable investments. This weakens Bitcoin's growth potential in the short term. However, when interest rates peak and central banks reverse course, Bitcoin is one of the first assets to recover, often front-running the broader financial markets. The crypto market isn't random. It moves in cycles, dictated by Bitcoin halvings, global liquidity, and institutional money flows. Understanding these factors gives you an edge, allowing you to position yourself ahead of the herd instead of chasing hype. We've covered why bear markets last years, what triggers bull runs, how FOMO creates massive crashes, and why tracking liquidity cycles is the ultimate cheat code for crypto investing. But here's the question. Do you think the next cycle will follow the same pattern, or are we entering a new era for Bitcoin? Drop your thoughts in the comments below. If you found this video valuable, hit that like button, subscribe for more high-level crypto insights, and turn on notifications so you never miss an update. Big things are coming in the crypto space. Make sure you're ready. We'll see you in the next video.